Okay, I have got a couple minutes after, so we'll go ahead and get started. Thank you all for joining us today. We're excited to have you here. I might be a new face to some. My name is Katie Alexander, and I am the new communication director for MCCA. So I'll be facilitating today. Cliff Judy, our new member engagement director, he's a new face that you may see as well soon. He's on the road today, but should be able to join us for future webinars. So just a couple of housekeeping items to go over before we get started. You all are muted just to prevent background noise. So if you do have a question throughout the presentation, please feel free to type those in the chat and we will kind of answer those as we go. We're also recording today's presentation, just a reminder. So we will have that available via our YouTube channel for you to go back and watch and review. Yeah, so today our webinar is going to be broken into two presentations. So our first one will go until 11:30. We'll take a quick 15-minute break and then reconvene at 12:45 for our 11:45. I'm sorry, for our second presentation. So with that, I am happy to introduce our first presenter, Brandy Marion with BOK Financial. Brandy is a senior vice president and manager of education with institutional wealth management at BOK. In this role, Brandy coordinates a team providing all aspects of employee retirement planning education, including comprehensive educational needs assessment, campaign design, campaign management, and direct education delivery. Brandy is a qualified licensed financial consultant and holds the Chartered Retirement Planning Counselor certification from the College for Financial Planning. So very excited to have her here with us today. And I will go ahead and kick it over to you, Brandy.
Thanks, Katie. The first thing I want to tell you, just take a deep breath. We are going to hit every aspect of pre-retirement planning. It is a lot. Please don't feel that you have to understand or know all of it. For one, everything I'm telling you is as of today. Congress can change any of these rules and make a liar out of me tomorrow. And two, you can always get back in touch with Katie if you have questions later on, and she'll get a hold of me, and I'm happy to help go through anything that you feel that you didn't really get a good understanding on. So it's going to be a lot. Fortunately, it's recorded, so you can go back and watch it again. And secondly, you can always get a hold of me, and I'm happy to help walk you through any of it. So we always kind of talk about retirement as far as how much do you need to save. It's all about money. But I want you to think about the lifestyle. More and more of us absolutely love what we do, which is wonderful. But then it becomes, it's not so much a job, it's our calling. And what happens when we retire? Who will we become? And so some things I want you to think about, what are you going to do? Where are you going to live? Definitely set a retirement date for yourself and your significant other. Kind of think about that, but think about how you're going to spend every single day. Every single day will be Saturday now. What's interesting is AARP did a study and found out all those honeydews that we've been meaning to get to, we get those done within 90 days. We're very productive people. So what are you going to do on that 91st day? Do you want to retire early? There are still some people that want to retire in their 50s. And you know what? If they can, that's wonderful. But some things to think about. You have fewer years to save, longer time to pay out. When will you start taking Social Security, and what will you do for health care? If you're delaying your retirement, maybe you don't want to retire till your 70s. I definitely hope if that's what you're wanting to do, that you can. Not everything's in your control. The nice thing about delaying retirement, more time to save, less time to pay out. You definitely can make an impact on your Social Security benefit and health care. What we found is a lot of people will retire, they'll go and they'll travel and they'll see the grandkids and they eat out and they just do everything that they've been planning to do for the last 40 years. But once that's over, and it could be I would say within 5 years of retirement. What's interesting is we've looked at retirement and we now have 3 phases of retirement. You know, there's 3 phases for everything, 3 phases of life. The first third of your life, you're a child and you're learning. And the second third of your life, you're working and raising that family. And the third part of your life, you're retired. Well, now they've broken down retirement into the go-go years, which are usually in our 50s and 60s. We are just going and doing and just having a ball. Then when we hit our 70s, it's more of a slow go. We're slowing down, but we're still going. When we approach our 80s, it's usually no-go. We're more in, people are coming to visit us now. And so things to think about during the go-go and the slow-go years, we're seeing more and more people, they're either volunteering or going back to work, and they're doing things that they love, things that were hobbies, and they're getting paid for it. And it's not so much for the paycheck, and it's not so much for the health care, it's for our psyche. It gives us a reason to get up. So be sure you're thinking about other significant things that are going to affect your retirement, not just the money. We'll get to the money, and the money's the easy part. Think about your psyche, because we are living longer, which is wonderful. We're going to see grandkids and great-grandkids. And just think about when you first started the workforce. When I started, there was no internet. Now look where we're at. No cell phones. Well, there were cell phones when I started the workforce, but they were so expensive, nobody could afford them. So the next thing we want to think about is income. Where are we going to get our money to basically give us that retirement paycheck? We get our money now through a paycheck. How are we going to create a sustainable income plan? And how are taxes going to affect our income? On our website, we have what's called a My Retire Right Planner, and it basically is a really quick and dirty method to stress test your retirement plan. It just kind of goes through and kind of gets you to put everything that's in your head down on paper or on the computer. And I'm sure you guys have something out on your website. It might be called a gap calculator, but if you'll just take, usually they take like 5 minutes. They're just looking, when do you want to retire? And whatever age you put down, be sure to put 30 years of retirement because you don't want to run out of money. And then how much are your expenses going to be in retirement? If you're not sure, you know, you can estimate 80 to 85% of your current income now. How much have you saved as of now? And where is it? Is it in some old retirement plans? Have you left them behind? How much are you going to get for Social Security? When are you going to start taking Social Security? So just some things to think about. What we found is we all have ideas in our head, but let's put them down on paper and let's really start stress testing them. You know, inflation, be sure to add in inflation rates. You know, 3 to 4%. Taxes, how much are you going to pay in taxes? Because that's a very real part of retirement. Experts recommend that we save 10 to 15% of our salary every single year, just so we can hit those retirement goals. You, after doing your gap calculator, you may realize you need to save more, or maybe you don't have to save near as much. What I will tell you, this 10 to 15% isn't all on your shoulders. This is you contributing plus any contributions that you're going to receive from your employer. Talking about your employer, you know, think about what is the maximum that you need to contribute to get all of that match or that profit sharing. Do you have to be there on the last day of the plan year to get it? And don't forget, whatever the match is, you can usually contribute more. I've done this for 20 years. I run into retirees all the time. And I will tell you, not one of them has said, Brandy, you should have stopped me. I saved way too much money. It's really interesting. We get that match and we put in that amount, but we forget that we can contribute more. And when you retire, whether you've saved $10,000, $100,000, or $1 million, I doubt you're going to feel like I did it. I saved just enough. It is your money. So just make sure you're receiving all your free money, but make sure you've done that gap calculator to see what is the amount that you should save for your retirement plan. Is there a vesting schedule? Do you have to be there for a certain amount of time to collect all of the employer's free money? And of course, are there any other contributions that you're eligible for? And what are those rules? The one big important leg of the retirement plan stool is Social Security, and it's going to continue to be a very important part of retirement. It's not going away. I know that you hear news stories, and if you read LinkedIn or Twitter, they all say Social Security is going bankrupt. It's not going bankrupt. It will never go bankrupt. And bankrupt is zero. You were promised $1,000 a month and it went bankrupt and you're getting zero. It's interesting because we forget, how is Social Security funded? Well, it's funded with taxes that you and I pay through our payroll, usually 6.2% from us, 6.2% from our employer. And those, the only way it could go bankrupt is if Congress decides no longer to charge us those FICA taxes. And so it's not going bankrupt. Now, what's going to happen, when Social Security was created in the late 30s, there was more money going in than coming out. And so it built up a huge reserve. In fact, that reserve's worth over $4 trillion with a T, trillion dollars. It is being depleted right now, and it is going to continue to deplete if Congress doesn't make any changes. And the last time Congress changed Social Security was early to mid 80s. And if you'll remember, used to, Social Security, we all got it at age 65. They made changes to that. Now, to get your full retirement benefit, you have to be either age 66 or 67. I'm sure Congress is going to go ahead and make changes to that as well for the millennials and the Z generation. It was also, FICA at that point was 2%. Well, it's 6.2%. So they've changed FICA on us all throughout the years. And it used to be a tax-free benefit. Well, that's no longer the case anymore either. So the first thing I want you to do is go out to the Social Security website and click on the My Social Security. Enter your information so that you can see what you'll get for Social Security. When you go in, that PDF, you're going to get a PDF, and it's going to look just like it did in the 80s and 90s. It's got that dark green border. And on page 3 are all of your earnings that have ever been subject to Social Security. And you want to pay attention to page 3. And we don't tend to pay a lot of attention to page 3, but we need to, because if they have underreported your earnings, your Social Security benefit will be lower. Remember, your benefit is based on these earnings. In fact, it's based on 35 of the highest years. So if you work 40 years, you get to knock off 5 of your lower paid years. If you only work 30 years, you're going to have 5 years of goose eggs. They don't take your total number of years and just average them out. They are looking for 35 years. The other thing is, if they did underreport it, you only have 36 months, 3 years to contact them and get them to change it. So if you get out there and you see something was incorrect in 2015, there's nothing you can do about it. Now, hopefully they've overestimated your earnings, but chances are they underestimated them. So be sure that you're checking this every single year. Be sure you go to page 3 first to make sure all that information is correct. If it's not, get a hold of Social Security. They will contact the IRS and they'll get it updated for you. Spoiler alert, it might take them almost 3 years to get it updated. When you do call them, make sure you get the name and the employee number of the person that you talk to and make really good notes. Get that retirement file going and get really good notes. Most of us go to page 2. It tells us, I'm going to get this amount when. If I'm at 62, I'll get $1,000 a month. At my full retirement age, I get $1,500 a month. But if I delay it to age 70, I get almost $2,000 a month. So page 2 is the one that we're really interested in. Another interesting thing that people may or may not know, you can work and you can collect Social Security, but it's tied to a certain dollar amount that you earn, and it's wages only, so it's W-2 or 1099. In 2021, the most that you can earn before they start reducing your Social Security benefit is $18,960 a year. So just for ease of example, let's say it said $18,000 even. When you go and apply for Social Security, you always go out 90 days before. It takes them that long to get you into the system. And then you wait one more month because they pay you in arrears. So it's about 4 months before you get that very first check. You're going to answer some questions, and one of them is, will you be working, and how much do you estimate that you'll earn? Well, if I went out and said, I estimate that I'm going to earn $15,000, they're going to go in and they're going to calculate my benefit based on the years that I've already worked, based on what I said I'm going to earn. And if I'm age 62, 63, 64, or 65, if my full retirement age is 66, if I'm any of those ages, if I go above that $18,000 limit, they're going to reduce my benefit by $1 for every $2 I go over. So I said, I think I'm going to earn $15,000. Well, then I get my W-2 at the end of the year, and I earned $20,000. Now, I wasn't lying to the IRS. I just miscalculated it. But I've gone $2,000 over the limit. I'm going to owe Social Security $1,000. They're going to send me a note. It's going to tell me I went over the limit, and then it's going to recalculate my benefit for the next year, and it'll reduce it. The year I turn my full retirement age, FRA, full retirement age, I can make up to $4,200 a month. And if I go above that, they'll withhold $1 for every $3 I go above it. Once I reach my full retirement age 66 and maybe so many months, or age 67 for everybody that was born after 1960. If you're born after 1960, your full retirement age is 67. You can earn $1 million in salary, and they're not going to reduce your benefit. They'll still tax it, but they're not going to reduce it. And again, it only applies to wages. So if you have money coming in from rents or royalties, or you took a distribution from another retirement plan or an annuity, that does not count towards that annual dollar limit. And it does go up. The IRS gives us, some inflation factors. And so it goes up sometimes by $200, $300 a year, sometimes by $500 or $600. You can always Google it and see what the current limit is for that year. There is a value of waiting. It's interesting that AARP did a study a few years ago when baby boomers started turning 65. And so they looked at it, and what's interesting is 10,000 people turn age 65 every single day, and they're going to do that for the next 20 years. The next 20 years, 10,000 people are going to turn age 65 every single day. That is a lot of baby boomers. They asked them, when do you think you're going to take your Social Security? Almost all of them said, I'm taking it early. I'm going to take it at age 62. And they said, okay, why? And the number one answer, they wanted to get it before it was gone. They wanted to get their benefit before it was gone. I don't care if you take it early, and there are reasons to take Social Security early. If you need the money, take it. You've earned it. If your family, basically has heart problems or health issues, and almost everybody in your family passes away before age 50, and you're 62 and you're surprised you're still alive, you may want to take it because there's no guarantees that you'll be alive on your full retirement age, or even if you delayed it. So there's reasons to take it early, but to take it early based on a myth kills me. Another thing that they thought was, well, I'll take it early and I'll take that hit. And by the way, if your full retirement age is 66 and you take it at age 62, you'll take a 25% hit. And that hit stays with you forever. They really misunderstood, and they thought, well, I'll take it early, I'll take that 25% hit, but when I hit my full retirement age, it'll go back up to the full benefit. It will not. So two really bad information sources came into these people, and they took it early. And I just wanted to show you the value of waiting. If you're healthy, if you're planning on working, and if you don't need the money, you will get an 8% raise in your Social Security benefit every year you delay it from age 62 to age 70. So that's a 132% raise on what your annual benefit would be. And the interesting thing is, if those people had just waited 4 years from age 62 to age 66, they would have gotten $500 per month extra for life. That's $6,000 extra a year. If you live for 20 more years, that's $120,000 extra dollars. That's a huge, big gap that if you didn't need the money and you took it because you either thought it was going to be gone and it was going bankrupt, or you thought it would transition back to your full amount at your age 66, at your full retirement age, that's a big miscalculation. If you wait until age 70, it's over $1,000 extra a month for as long as you live. And so it is a complicated choice, and it's because there's a lot of unknowns. If we knew when we were going to die and we knew what our tax rate was, you wouldn't need retirement planning. It'd be easy. But there are a lot of unknowns. I will tell you, if you're part of a couple, we always urge the higher earner to wait, to delay it for as long as possible. The lower earner, if they want to take it early, go ahead, because when you're part of a couple, when one of you passes away, the other one gets to choose to take one of those checks, and you're obviously going to take the check that is larger. And so if you live, to 100 or even 95, you really want to make sure that you get the biggest benefit out of it. The problem is you can live till age 69 and 11 months and a bus hits you. And if you were waiting to take it till age 70, you will get zero in Social Security benefits. So it definitely is a very hard decision to make. I definitely recommend you sit down with an advisor or somebody and have them run some numbers for you. Almost all financial advisors now have Social Security calculators that can help you decide when is the best, most optimum time for you to take your Social Security. Will your Social Security be taxed? Well, for some of us, yes. For some of us, maybe not. It really comes down to what is the definition of income. And so when you start collecting Social Security and you enter it onto your 1040, your tax form, there is a calculation that's done behind the scenes. And this is the calculation that's done. The first thing that they look at is all your other adjusted gross income, your AGI. Did you have wages from a W-2 or a 1099? Did you take a distribution from a retirement plan that was in a pre-tax bucket? Did you get an annuity? Did you have pension income? Did you have gambling income, baby income, right? Anything. Then they look at tax-exempt income. So tax-exempt income is like a municipal bond. So in Missouri or Kansas or Oklahoma, we all have state taxes, which means we all have municipal bonds. And as long as we buy a municipal bond in our state, we don't have to pay taxes on that income. So if I get $1,000 from an Oklahoma muni bond, I can spend that $1,000 and I don't have to pay the taxes on it. But to determine if my Social Security is taxable, I have to add that $1,000 into this equation. Then, if that's not, I just kind of think it's an affront that they're taxing or they're using my tax-exempt income to determine if my Social Security is taxable. Then they make me add in half of the Social Security benefits that they sent me that year. So if I had $30,000 worth of Social Security benefits, I have to add in $15,000 to come up with this combined income number. Once you add all that information up, whether you file single or married filing jointly, if that combined number is less than $25,000 or jointly less than $32,000, none of your benefits are taxable. If that number is between 34 and 25 and 44 and 32, 50% of your benefits are taxable. If it's above the 34 or the 44,000, up to 85% of your benefits are taxable. And basically what that means is if you got $10,000 worth of Social Security benefits, if you were in the 50% taxability, you would have to add $5,000 to your income and pay taxes at whatever your ordinary income rate is on that $5,000. If it was in the 85%, you have to move $8,500 over to the income column and pay taxes on that. The really scary part is this slide has never had to be updated since the early 90s. The government has not given us a cost of living increase on our Social Security being taxed. So you really want to know what is the definition of income, because it really makes a difference. Let's do some numbers. If I got $30,000 in Social Security benefits and I decided I wanted to withdraw $18,000 from one of my IRAs, if I withdrew that $18,000 from my traditional or my pre-tax IRA, not only do I have to declare that $18,000 and pay taxes on it, but now I've got to add in that $15,000, half of my Social Security benefits, to come up with my combined income number of $33,000, which means 50% of my Social Security benefits are taxable. If I was to take that $18,000 from my Roth IRA, I can spend that $18,000, and as long as I've had it for 5 years and I'm over age 59 and a half, none of it's taxable. And another interesting thing is it's not included in income. It is income, but it's not the definition of income that the government's looking for. So if I withdrew that $18,000, I'm still living on it, I'm still spending it, but now I only have to declare that $15,000 in Social Security benefits, which means not only do I not pay federal or state taxes on the $18,000 I withdrew from the Roth, but I don't have to pay any taxes on my Social Security. So if you have the option of a Roth, whether it's a Roth IRA or a Roth contribution inside your plan, you may want to do some more research on it. Even though you have to pay taxes up front, it does become a pretty powerful tool in retirement. Definitely pay attention to taxes. So as you are getting into retirement and you're now supplementing your own paycheck with your Social Security and things like that, the market, while it seems to be scary, it's actually going to be less scary. Inflation and taxes and fees are actually going to be more scary to you than the market. So definitely, wherever you're getting income, just know, how is it taxed? What state are you going to retire to? Because it doesn't matter where you made the money, it only matters where you are domiciled legally when you take that distribution. And we do have several states that do not have a state tax, and that might save you a little bit of money. But before you start running off to, Florida, Texas, Wyoming, South Dakota, make sure you look at what the property taxes are. Sometimes the property taxes can be more than what the state tax would be. Again, I urge you to talk to a tax advisor or financial advisor to help you with questions like this. So let's talk about the two ways you have to save for retirement, whether it's inside your retirement plan where you work, or is it through an IRA that you can open outside. Most of us have the ability to make a pre-tax contribution, and some of us have the ability to make a Roth after-tax contribution. So when you make a pre-tax contribution, any money that you put into that bucket, you don't have to declare it. So if your salary was $20,000 a year and you contributed $1,000 into that pre-tax bucket, You would be living on $19,000, but you would only have to declare and pay taxes on $19,000 because according to the IRS, the $1,000 that you put into that pre-tax bucket does not exist. Whatever investment you choose to invest those contributions in, maybe it doubles. So now it's worth $2,000, as long as it's in a protective wrapper, like a retirement plan, a 401k, a 403b, a 457 plan, 401a, or a pre-tax traditional IRA. You can make as much money as you want, but it's got a wrapper around it. It's protected from the taxes and from the government. Only when you open up that wrapper, maybe you take a little bite of that candy. When you take a withdrawal or a distribution from a pre-tax bucket, you now have to declare that as ordinary income, add it to any other income you have through that year, pay whatever taxes you're in, and you go down your merry way, except if you're under age 59 and a half. If you take a distribution and you are under age 59 and a half, a lot of times the IRS is going to charge you an extra 10% penalty on top of the federal and state taxes that you'll have to pay on that income. And so pre-tax has some advantages. You can control your taxes to some degree. So with pre-tax, if I think my taxes are too high right now, I can contribute more to those buckets. I can put more money in those pre-tax buckets. Now, I've still got to save some money to live on, but I can put more money because the more I defer into those buckets, the lower my taxable income is for this year. So the less taxes I pay. The problem is when I take it out, there's some unknowns. How much am I going to need? You are in control of how much you withdraw. And so you can look at all your other income, you can look at whatever the tax brackets are going to be, and you can withdraw a certain amount and try to control your taxes at retirement. But, you know, when we retire, I really don't want you to have to feel like, gosh, I can only withdraw this amount to pay these kind of taxes, because the less that you live on, the lower your standard of living. And so that's one of the catch-22s. The other one is, what will your tax bracket be? What do you think the government's going to do with taxes in the next 10, 20, or 30 years? Because the real thing that we're trying to get to is we want to make the most money and pay the least amount of taxes. But it's hard because the IRS does not tell us what our tax brackets are going to be until the October of the year before. So we don't even know what the tax brackets are going to be for 2022, much less 2030, 2040, or 2050. So there is an unknown. And so those are some things that you're going to have to juggle. Roth says, pay your taxes now. You make that contribution, but you don't get a tax deduction. That doesn't feel good up front because I'm going to make the contribution and pay the taxes on it. But if I'm young and in a low tax bracket, I can lock it in. Who cares what happens to taxes in the future? I'm going to lock in that tax bracket because I know what it is. The best part about the Roth is the earnings can be withdrawn tax-free. You're not going to defer your taxes. You're going to get rid of them. And so the deal with the Roth is, as long as you have it for 5 years and you're over age 59 and a half, your earnings will be distributed to you tax-free. And we can make contributions for both pre-tax and Roth. If it's in a qualified plan like a 401k, a 403b, you can make both contributions and there's no income limits. If, however, you only have pre-tax contributions at work, you can open up a Roth IRA, but there are some income limits. So you either want to Google them or you want to talk to a financial or tax advisor. And the investment options are usually the same, no matter which bucket you pick. You want to find the investment that's going to make you a millionaire. You, on the pre-tax and Roth, just kind of want to decide how you can use those to both leverage the ability to make the most money and pay the least amount of taxes. What I will tell you is no matter which bucket you choose, Employer contributions are always made pre-tax. So if you're only saving pre-tax and you've got that employer match or that employer profit sharing contribution, you're going to have a bigger pre-tax bucket than what you thought. So let's think about that. If I was to put $1,000 into each one of my plans every single year for 40 years, I would have contributed $40,000. Taxes on the contributions. Well, if I make those contributions into the traditional pre-tax bucket, I don't owe any taxes because remember, I'm deferring those taxes. However, if I make them in the Roth, I have to come up with another $8,000 throughout those 40 years, which means I have less take-home pay. If the 40 grand earns 7%, I'm going to earn around 170,000 on it, and I'm going to have a total balance of over 200,000. Now, it's retirement time, and I'm going to take a withdrawal. If I withdraw my money from the pre-tax bucket, even if I'm in a lower tax bracket, I still have to declare it, I still have to pay taxes on it, and then I get whatever's left over. And that goes for those employer contributions as well. You've deferred the taxes on the employer contributions, but when you take a distribution and you withdraw money from those employer contributions, you have to declare those as income and pay taxes on them, just like you would any of your own pre-tax contributions. The Roth, however, is a little different. That $40,000 that you contributed throughout those 40 years, that comes out. You don't have to worry about taxes because you already paid them. They can't tax you twice. But that $170,000 in earnings, that's going to come out tax-free as long as you've had it for 5 years and you're over age 59 and a half. I think both buckets are really good. And if you can have both buckets, it just gives you some more options at retirement, like not having to pay taxes on your Social Security, or if you have both buckets to withdraw from in retirement and you decide, I want to live on $40,000, and you withdraw $20,000 from your pre-tax bucket and $20,000 from your Roth bucket, you're living on $40,000, but you only have to declare and pay taxes on $20,000. The Roth gives you some advantages and some options in retirement. The only bummer is you got to pay those taxes up front. Things to think about when you're investing. As you get older, you do want to become more conservative, but you don't want to be so conservative that you are preserving your principal, but you're not keeping up with inflation. Your purchasing power is going down. You definitely want to make sure that you have an emergency account. You know, you want to cover a minimum of 6 to 9 months. And if you're a nervous Nelly, we tell people maybe you want to have 3 years worth of expenses on there. Because if the market goes down, you never want to have to sell any of your investments at a low. Definitely reassess your risk tolerance probably every 5 years so that you can make sure that you're still appropriately invested, meaning you still have the right mix of stocks, bonds, and cash. Almost all plans have the ability to go out and do some questionnaires to see what type of investor you are. When you're thinking about structuring your portfolio as you get closer to retirement and in retirement, start adding up your expenses and what's that total amount? What are your needs? Can those needs be provided by guaranteed sources of income like Social Security, pensions, annuities, bonds that pay a certain interest amount, or even just your emergency cash base? What are your wants? If here's your needs and you've actually got a little bit of wants in there, you may want to put those in equities or bonds. And then if you're wanting to leave something behind to your grandchildren or your children, you may want to take a little bit more risk and put it in some higher risk equities and stocks and maybe even some alternative investments. When you're thinking about setting up your asset allocation, you want to think about, when do I need the money? And you can actually go into your account and you can say, okay, my near-term needs, I'm going to need $3,000 every single year just to live. If you are okay with the stock market's ups and downs, you can have $3,000 in cash. So when you're looking at either your work plan or your IRA or your Roth IRA, you want to look at whatever $3,000 is as far as having that in cash. If you're a nervous Nelly and you're thinking the stock market makes me crazy and I'm going to be even crazier in retirement, you may want to put 3 years worth of that in there, because when we look at bear markets, on average, they last about 18 months, but they can last as long as 3 years. So what you're trying to do is cover your basis while the market recovers. If I'm a nervous Nelly, I may want to have $9,000 in cash. And again, this can be inside my retirement plan, or I can withdraw it and have it in an emergency fund, however you want to do it. Your intermediate term needs, so money that you may not need for 10 years. You can put that in bonds, and maybe you have 70% in bonds and maybe 30% in equities. And if you want, you can have some in alternatives. Longer term needs or legacy needs, money that you won't need to access for 15 years, you can definitely put more of that in stocks and alternatives, and still have a little in bonds. If you have a target date fund, the nice thing about the target date fund is they kind of keep you allocated as far as stocks and bonds. May need to work on the cash and pump up the cash on that. But what we like to tell people is you don't want to go 100% conservative, because then inflation rises. And, right now, current interest rates on CDs are so low and inflation is starting to rear its ugly head. You just want to make sure that your money lasts for 15, 20, or 30 years. But you don't have to have all of it in stocks or bonds. And here, anytime you're looking at it, maybe you sit down once a year and you look at it, or you have a financial advisor look at it. If any of your stocks or alternative investments or even your bonds have created income for you, you can rebalance it each year, sell the profits, and then move it into that next bucket till it's always going into that cash bucket. So you'll always have cash when you need it. You'll never have to withdraw in any equities or alternatives when the market is down. So just an idea, we call it the bucket withdrawal strategy. Definitely something to look at. And again, almost all financial advisors are very familiar with that strategy. The best bet I can give you to have a great retirement is to get rid of as much debt as you can. And that does include the mortgage debt. What you first want to do is find out what is your debt to income ratio. So you're going to take all of your monthly debt payments, add them together, divide it by your gross monthly income, and you're going to come up with a ratio. What you're trying to do is get to less than 36% by the time you get to retirement. So go ahead and just do that in your mind, figure out where you're at, and all you're trying to do is get that debt paid off. Credit card debt, have that paid off. Mortgage debt, talk to a tax advisor about whether you should go into retirement with mortgage debt or if you should have it paid off. There's different ways of looking at it and different tax advantages. One surefire, should you or should you not do it, doesn't apply to everybody. So when you're thinking about things to do to boost that retirement income, you can increase those contributions today. If you increase your contribution rate by 1% for the next 10 years, that's going to be 10%. And the best thing is when you do it just by 1% each year, you don't feel it. That's the best way to save. It's almost like dieting and getting to eat chocolate cake every day. Definitely look at your expenses. What can you get paid off? How can you live on less in the future but still have a great retirement? Retire later. And I'm not talking 5 years later or even 10 years, 1 or 2. Will 1 or 2 more years working really help you to pay off some more debts or invest some more money? And just don't be too conservative. I would never tell a 20-year-old to be 100% stocks, but I would also never tell a 50, 60, or 70-year-old to be 100% fixed income. Healthcare is scary. Healthcare is undergoing lots of changes. And as I go through all of this information, just know Congress is looking at a lot of it. Right now, most of us will transition from our employer coverage to Medicare. Used to, they would send you your Medicare card at age 65 and you would have to either accept it or decline it. Right now, they're not going to do that at age 65 because so many of us are continuing to work past that age. And so whenever you do retire, you just want to make sure 90 days before you retire that you set up your Medicare account. That's all you need to do. You'll go out to the website, 90 days, you'll be ready to go. That way, when you transition off of your work healthcare, the next day you'll transition right onto Medicare. There's 4 parts of Medicare. We're all very aware of Part A and Part B. Part A is hospital care. Hospital care, you're paying for it right now through your payroll taxes. And when you get into retirement, there is no monthly premium for hospital care. And so if you are not actively saving through an HSA account, when you turn 65, go ahead and sign up for Part A hospital care. When you do that, it becomes secondary coverage after your work hospital medical insurance. If you are actively saving inside of an HSA account, do not sign up for Part A. Even though it's free, which it's not free, you paid for it your entire working career, but there's no monthly premium. HSAs have little funky rules, and if I'm contributing to an HSA and I have any part of Medicare, I'm going to have to take all those contributions out that I made during the same year that I accepted Medicare, and I can no longer save inside of it. I can take distributions from my HSA, but I can't actively save. So definitely before you decide, I'm going to get Part A because it's free, and that's what they'll tell you, sign up for it at 65 because it's free. It's not free. You paid for it. Just make sure if you have an HSA, I have to do some further investigation. And you do not want to sign up for Part A if you have that HSA. Part B is the medical insurance. It does have a monthly premium for 2021. For most of us, it's $148.50 a month. It is based on income, though, and it can go up to $500 a month. Another reason to have that Roth income. The original Medicare, Part A and Part B, is an 80-20 insurance. The government pays 80%, you pay 20%, but there's no ceiling. If you had $1 million accident, the government would pony up $800,000, but you would get to pony up $200,000. So there's no ceiling. So something to think about on that. A lot of people who choose original Medicare, and they like it because you get to choose your own doctor, you get to choose your own hospital, you get to choose your own specialist. If they take Medicare, we'll usually buy a supplement plan, and that supplement plan will give them that ceiling that covers their 20%. A lot of people are now moving to Medicare Advantage plans. You see them on TV advertised all the time, Joe Namath, J.J. Walker. So Medicare C is it's like a PPO or an HMO. You're now in a plan. You now have to decide what hospitals and doctors do you want to see, and they have to be within that plan. Part C, it costs the same as it would for Part A and Part B. In fact, now some Part C plans will pay that monthly premium for you of $148.50. A lot of Part C plans will have the prescription plan included. They will also have dental, hearing aids, eye, vision, gyms. And so what you want to do when you're deciding, if you go original Medicare, you may want to choose the supplement plan. If you do, you want to sign up for that supplement plan when you're very first eligible, because they won't do a health check on you. If, however, you've signed up and 2 or 3 years later you add a supplement plan to you, they will do a health check and they may deny you coverage. So if you're thinking, I want to do original and I want that supplemental plan to help protect me, you want to do it that very first year that you're eligible. But you're definitely just going to have to think 2 paths. I'm either going to choose original Medicare, Part A and Part B. You'll need to buy a Part D plan, which is the prescription drug plan, and you may want to buy that supplemental insurance plan as well, or you'll choose Part C. And that's got the A, B, and D in it, and it usually has some extra like vision and dental. Right now, Congress is looking at adding dental to original Medicare, so lots of changes are always going on. If you do choose Medicare Advantage, Do not buy a supplemental plan. First of all, it's illegal for them to sell it to you. So if you have an insurance agent putting you in a Medicare C plan as well as supplemental, warning bells need to be going off. To see what plans should be available to you, you can go out to the Medicare website, find health and drug plans. If you're on a monthly prescription, you want to put that in there. It's going to go through all those Part C plans and filter them down for you. If you want to add in a doctor that you like or a hospital that you like because you want to do a Part C plan, and again, they're all different in all locations, you want to add those doctors' names and those hospitals in. And again, it just continues to filter down the information for you. The website is really, really good. I do recommend that you guys go out there and look at it. And the one thing I want you to know is you get a chance to re-enroll in Medicare every single year. So if you started off with original Medicare, but you want to go to a Part C when they have open enrollment, you can make that change. So you're never stuck in any plan for the rest of your life. Think about distributions. So when you are leaving your company, when you're separating from service, you can usually leave the money in the plan for an indefinite period of time. It's usually based on a dollar amount, less than $1,000 or less than $5,000 in balance. So if it's above a $5,000 balance, go get everything else set up for retirement, then deal with what you're going to do with your retirement plan. Some retirement plans allow you to take distributions directly from them, so you can do a monthly distribution. Some only allow required minimum distributions to come from them, so things to think about. If you have to move your money, if the plan says, look, we helped you accumulate it, but you've got to go figure out how to distribute it, you can always open IRAs or Roth IRAs at any financial institution, banks, brokerage firms. You can go online now directly with those companies. When you open up IRAs, you want to look at what are the investments available to you, is there a financial advisor available to you, and what are the fees and charges. You always have the ability to cash out, but anytime you cash out, you have to add that income and you got to pay taxes on it. And you really want to be tax savvy when you get into retirement. So let's look at the rules. When you separate from service at age 55, you can actually take a withdrawal directly from your plan. You'll still have to pay taxes on it, but you don't have to pay the early withdrawal penalty. And that's only from a qualified plan like a 401k, 403b. 457s don't have 10% early withdrawal penalties on them anyway, so that's kind of nice. Once you turn 59 and a half, it doesn't matter where you take the withdrawal from, a qualified plan or an IRA, there's no more early withdrawal. You can start taking Social Security as early as 62, but you really want to think about, should I take it at 66 or 67? And if you want to sign up for Part A, that hospital care, you want to do that 3 months before you turn age 65. If you've put off Social Security, you don't want to put it off anymore. Once you turn age 70, there's no more 8% increases. So you definitely want to take it by age 70. And now any monies that are in a pre-tax bucket, you have to start taking them out at age 72. Used to be 70 and a half. They changed that. They're looking at changing it again to age 75. So again, keep Googling these things to see what the new numbers are. Required minimum distributions scare a lot of people. They shouldn't scare you. Basically, any money that you've had in a pre-tax bucket, you have to start withdrawing it and you have to pay taxes on it. The government says you've deferred it long enough. And what they do is once you turn age 72 and you're no longer working, they'll look at the balance on 12/31. You'll see what kind of ratio it is based on your age, and you'll take that amount out each year. It's not a whole lot. The first year it's about 4% of your balance. So if you have $100,000, you'll be required to take out $4,000. And don't panic too much. All IRA custodians, all retirement plans have people that do these calculations for you. You just need to make sure that you take that money out each year. So things you want to think about. Trying to not go through probate will be something that's really important to you. And so you want to make sure that all your accounts have beneficiaries attached to them. It doesn't go through probate. So just make sure your work accounts, any annuities, insurance, they all have beneficiaries assigned to them. So go out and do a check on those. If you have a savings account or money market account, add a transfer on death to it. That way, if something does happen to you, whoever your executor is, if you've got them on transfer on death, they can come in. A lot of states have what's called a real estate transfer on death deed, so the house doesn't even have to go through probate. Definitely joint ownership, so whoever's left standing now gets all ownership. Make sure that you always update your beneficiaries. Almost all plans allow you to do it at any time. They don't automatically update. And we are a highly regulated industry, which means whoever is listed there, that's who we have to give the money to. And I can tell you during COVID, we gave a lot of money away to XXX spouses. So just make sure all your beneficiaries are up to date. Also, ask and see if you have a licensed financial consultant that's available through your plan. They're usually free. They're usually there to answer any questions that you have or give you a second opinion. Questions for me today? That was a lot, and we just finished 2 minutes ahead of time. Oh, I see, looks like we've got one question. Oh, yes, you can get a copy of the slides. I will send a PDF to Katie. And remember, Katie said she is recording this, and it'll be out on your YouTube channel. So you'll get to listen to it with my voice again, but I will absolutely send Katie a PDF of the slides.
Yeah, definitely. We will, when we send out the email with the link to the recording, we'll be sure to attach the slides to that as well.
I told you it was a lot.
That was great. Lots of good information. Do we have any other questions before we go or break? And like Brandy said, if you think of, a question tomorrow or think of a question a couple weeks from now, please don't hesitate to reach out to us at MCCA and we can connect you with Brandy to get those questions answered.
All right. Well, thank you guys for your time, and I will give you your full 15-minute break.
Thank you so much, Brandy. We appreciate it.
Thank you, Katie.
Okay, well, we're running about right on time, so we will take a quick 15-minute break and then reconvene here at 11:45 for our second presentation. So thank you, guys. There we go. It looks like it.
Is it flipping?
Yes. Yep.
Okay. All right. Then we're good. Thank you so much. Okay. So like I said, let's start very beginning and talk about what the system is. So we're considered PSRS peers, and really we are two separate systems. So you have PSRS on one side and you have peers on the other. And even though we are two separate systems, we still have three common goals, and that's what we were designed for, and that's what we try to do every day. Goal number one is to provide retirement security for Missouri educators and education employees after a full career. So what that really means is that we were established just for you. It was to create a retirement benefit for you so that you could live comfortably after you work that full career. That's our number one goal. That's why we were established. That's why we're here. And it's why we do what we do. So that's always at the forefront of anything that we think about or present in the future. Goal number two is actually to help school districts attract and retain the best and brightest educators and employees for our Missouri school children. So not only are we amazing for our members, but it's also a really nice recruitment tool for school districts because they can say, if you come work here, we have all of these benefit options to offer you, including an amazing retirement system through PSRS peers. So that's one goal that we have as well. And then 3, it's on us. It's on us to make sure that we manage the systems in a prudent and cost-efficient manner so that we can provide you that retirement security later. So it's on us, it's our responsibility to make sure that we are doing that in the best way possible. Now, as far as what does it mean to be in PSRS or PEERS, you might not even know which system you're actually in. A lot of our members don't. Maybe you've heard one or the other more, and so you might think you're automatically in PSRS just because you've heard that acronym more. Or you might think you're in PEERS because PEERS is easier to say, right? It's easier to say PEERS than PSRS. And so a lot of people will say PEERS, but it's really, it all depends on a couple things. So one, PSRS was established first. It was actually created in 1946, and it was only created for those who have a teaching certificate in the state of Missouri. So that's the one big thing that distinguishes which plan you're in. If you have a DESE-issued teaching certificate, you are automatically in the PSRS system in most cases. And so that's how we show them, or how we prove that they are different. Now, at the time in 1946, what they did was they actually decided not to opt into Social Security. And so that's why a lot of our people who are in PSRS don't pay into Social Security. Now, that's not always the case. There are some exceptions, but for a majority of our membership in PSRS, you're not paying into Social Security, and that was decided back again when they established it. So then fast forward several years later in 1964, they decided, you know, there's a lot more people who work at the school district than just teachers, certified staff. So let's create a plan for those workers as well. So in 64, they created the PEERS plan, which covers everyone else at the school district. It doesn't matter what employment you have or what job you have. If you're being paid by the school district and you're in a benefit eligible position, you're contributing into the retirement with PEERS. And so you get that retirement later. Obviously, that's for anybody who doesn't have that DESE-issued teaching certificate. Now, at that time, they made the decision to opt in to Social Security. So if you're in the PEERS system, you're paying into both Social Security and PEERS. And so that's why those numbers are just a little different as far as how much you contribute into the system. So hopefully after today, you can very definitively say which plan you're in because you now know the differences between the two. So as far as what we are, we're considered a defined benefit plan, and that's, you might have heard it as a DB plan. It's very different than a defined contribution plan, which would be like an IRA or a 403B or another type of plan like that. In those types of plans, you save all this money and then you take it out as you retire, but when it's gone, it's gone. That's how they're designed to work, okay? Hopefully it lasts you for a long time, but you just don't know. You also have to be in charge of investing it on your own and making sure that you're growing it in a conservative way or whatever that may be. Our system, it doesn't work like that. We're considered a defined benefit plan, and it's different. So what happens is you pay in the contribution every single time you get paid, you pay in a contribution to PSRS PEERS. So that comes into our system. It's mandatory. You can't opt out of it. So what we're doing is we're automatically starting you and saving for your retirement from the very first paycheck you get. So then you don't have to worry about it because it's happening behind the scenes. Now, at the same time, your school district is contributing as well. So your school district's paying in, they're matching your contributions, it's all coming into our system. And so the graphic on your screen today, the dollar sign graphic, it just kind of shows you, right? You have your employer contributions, you have your contributions, and all of that goes into one big fund and we invest it. And so then at the bottom of that, what comes out is a very small amount just to run the plan, so a small amount for system expenses, but the rest of the money comes out to pay our members their lifetime retirement. That's what it all funnels down into. And in the end of the day, you get your money back, and then you get beyond that a payment for the rest of your life. So it's a guaranteed lifetime benefit. And that's very different than those defined contribution plans like we talked about, because again, when the money runs out, that plan ends, but ours doesn't work that way. You're actually guaranteed a lifetime benefit no matter how long you live. It doesn't matter how much money you had in your account when you retire or anything like that. We pay you guaranteed for the rest of your life. And so you might think, well, how can you do that? Well, it's really all around those investment earnings. So if you look again at the graphic, the dollar sign, 62 cents of every dollar that we pay out to our retirees comes from our investment earnings. So that's why it's so important for us to manage the systems in a really cost-effective way, because we want to make sure that we have enough money in the bank to pay you and to guarantee that payment for your lifetime. And we're able to do that because we are very safe and secure. We're very well funded. And so you don't have to worry about that going forward either. Now, your first milestone that you're going to come to whenever you officially start your job, if you're just starting out, maybe you haven't been there very long, is what we call vesting. Vesting is when you hit 5 years of service. So at the 5th year, you are considered locked in and you're eligible for that future retirement benefit. Vesting is important because let's say I get my first 5 years in, or maybe 10 years in, whatever that may be, and I decide, well, you know, life took me in a different way and now I'm moving out of state and I just have to take my account with me. If I'm vested, I don't have to take it out, right? I can leave it here. And then eventually I'll be able to draw a retirement benefit from PSRS peers, no matter what, because I'm vested, I'm locked in, I have those first 5 years down, so I'm going to get a retirement later. But I also have the option of taking it out if I want to. So if I end employment and I don't want to wait for my future retirement with PSRS peers, I can transfer my account balance somewhere else. I can take it out as a refund. I have access to it because it's my money. It's the money I paid in. So you always have access to take it out. Keep that in mind if something happens and you end employment and you want to take a refund or you want to roll your account balance. We're going to show you all of your options and help you make the best decision for you. So how are we able to pay everybody that lifetime benefit? Well, it's because we don't really look at how much is in your account balance when you retire, but rather we use a formula to figure your retirement. And this formula is the same for every retiree, or at least it contains the same 3 components in the formula. So the first one is a benefit factor. The first component in the formula is always this factor, which is established by law. So it's a percentage, and it's different based on if you're in PSRS or if you're in peers. So you're going to have different percentages based on the system you're in. But that factor is established by law, and it's based on when you're eligible to retire. So for people who get to normal retirement, they're going to have the highest benefit factor. But we also have some early retirement options. So that might result in a lower benefit factor or some other type of variation in this first component. But that's going to be that first slot in the overall formula. The second component in the formula is what we call your final average salary. Now, the way that we figure this is we take your highest 3 consecutive years of salary. So think about your career so far and think about your highest 3 salary years ever in a row. Maybe it happened early on in your career, or maybe it's going to be where your last 3 years end up being your highest 3. Whatever that happens to be, we're going to pull out those 3 years and we add them up and divide by 36 to get the average. And that's what we plug into this final average salary. So again, I'll say your highest 3 years added up and then divided by 36, which is 36 months over 3 years, to get your final average salary. Now keep in mind, your high salaries in our system always includes, of course, your base pay, any extra duties you're doing, any kind of coaching or clubs or whatever that may be that you're part of, but also if you have the school district's health insurance, those premiums are added into your salary. So in our system, your salaries are always going to seem a little higher because it includes those health insurance, it's health, dental, and vision. So any of those premiums are going to be included. And you want to consider that whenever you're thinking about this middle component to the formula. And then the final component is your total years of service. So however many years of service you have, whenever you officially retire, whether it's 20 years or 30, or maybe you have 22 years and you purchase 3, so you end up with 25 years, whatever that final amount is, that's what we plug into that final component. And then we multiply those 3 things together to get you your single life monthly benefit option. So again, this benefit formula, we use it for every retiree. It varies based on when you're eligible, based on your highest 3 salaries, and based on how many years of service you retire with. But it's going to be the same 3 components no matter what. Now, when it comes to retirement, in our system, throughout life, you have different paths you can take, different choices, options, things of that nature. And it's no different when it comes to choosing retirement. There's several different paths you could go on, again, depending upon your life situation and what choices you make. So we have a lot of different ways to be eligible, and you're going to come to them all at different points in your career. So typically, the first one that our members reach as far as what they're eligible for is actually our disability program. We offer this to all people who are vested. So if you are trucking right along with everything and it's all going well, but then all of a sudden life throws you a curveball and you have an illness or an injury that prevents you from working. You can't work any longer. And maybe you're not quite eligible to retire yet. So you're in this time frame where you really don't know what to do. Well, that's where our disability program comes in. If you're vested, again, that's 5 years, and you're under age 60, you have this disability that prevents you from working, all you have to do is contact our office, and we're going to obviously make you prove it, right? You have to have some doctor or physician certification about your disability. But once you get all the paperwork in, you can begin receiving a monthly benefit from our disability program, and it can continue you for the rest of your life. So you just get that. It's sort of like a retirement, right? Or if later on, maybe a couple years down the road, I recover from my illness or injury and I want to go back to teaching or back into the school, then it's very flexible in the fact that it'll let me do that. I can go back and start picking up on my regular retirement eligibility later. So keep in mind the disability program, because you don't pay extra for it. You don't have to sign up for it. It's just part of your plan. So those are benefits you already have, and you can take advantage of them if that situation does happen for you. So then the next thing that a person the next path you might come to in your overall career is our early retirement options. And we actually have 2 different ones to talk about. So the first one is 25 and out. In this situation, you have to be under age 55 and have at least 25 years of service. So I've hit my 25 mark or 26 mark in the school. I'm not quite at retirement for full benefits yet, but I want to retire now and go do something else or move out of state or whatever that may be. I can retire under the 25 and out provision, accepting a reduced benefit. So it's going to reduce or lower my monthly amount, but allow me to retire a little early. And then our second early option is very similar. It's called age reduced. But to be eligible for this, you have to be between the age of 55 and 60. So it's a lot of times it's for those members who maybe started their career a little later in life. Maybe you've only got 5 years in, or you've only got 10 or maybe 15 years in. And so it's going to be a while before you reach that full eligibility mark. And you don't want to keep working that long. You want to retire at age 55 or 56 and, enjoy your grandkids or go travel or do something like that. I can retire under age reduced, accepting a lower benefit, but allowing me to retire early. So then the next path that a lot of our members find themselves on is our normal retirement eligibility. So there's actually 3 different ways to be eligible under normal. The first one is if you are at age 60 or higher with 5 years of service or more. So if I hit age 60 and I'm vested, I'm good to go. I can retire. I don't have to keep working if I don't want to. Or 2, I can retire once I reach 30 years of service. So it doesn't matter how old I am. If I hit 30 years in the school, I'm eligible for normal retirement. And then the third option is what we call the rule of 80, which is where we take your age plus your service and we add them together. And if it equals 80 or more, you're over the rule of 80, or a lot of people call it 80 and out. So whichever one of these 3 I hit first is when I'm first eligible for normal benefits. And again, when I say normal benefits, I mean I'm getting the highest percentage in the first slot of my formula. So remember, it's the benefit factor multiplied by salary multiplied by service. So in the factor portion, to get the highest number possible, I have to be eligible for normal retirement. One of these 3 ways. Now, one thing I will mention, if you're in the peers system, which again is the non-certified side of the system, okay, if you reach eligibility with 30 years of service or the rule of 80, then we offer you a temporary benefit, which is sort of like a bonus amount added into your benefit every month until you turn 62. So again, if you are in peers and you have 30 years of service or the rule of 80, and assuming you're under age 62 when you retire, then you can have a temporary benefit or a bonus amount until you turn age 62. And if you want more information on that, all of this is on our website. We're always here to help. I'm going to give you all that contact information at the end so you can reach out, look into your situation, or just go online yourself and kind of look at what your options are. That's a really easy way to do it as well. So the final path that our members find themselves on is, I want to keep working. I'm not quite ready to retire. I've hit rule of 80 or I've hit age 60, but I'm just not ready yet. So you keep working a little bit longer. When you reach where you are 3 years beyond that normal retirement mark, then we give you an additional option, and we call it the partial lump sum, or PLSO. So in order to hit that mark, you have to be age 63 with 8 or more years, or you have to have 33 years or more in the system, or what we call the rule of 86, which is where your age and service added together equals 86 or more. Once you reach that eligibility mark, then we're going to give you the option of taking out a lump sum whenever you retire. So you still get a monthly benefit. We're still going to pay you every month for the rest of your life, guaranteed no matter what, but you also get the chance to take out a lump sum if you want it. So you can take out a big chunk of your retirement one time when you first retire. Maybe you want to pay off your house, or you want to buy a boat, or you want to invest it on your own, or various other reasons why people would take partial lump sum. There are things to consider in that category. Obviously, it's taxable money, so you want to think about that. A lot of people will ask about taxes in general. Your monthly benefit is also taxable. So when you start your retirement from us, you want to think about that, right? It's like a paycheck. Okay, we're going to pay you every month, like clockwork. That's what happens from PSR's peers. So it's just like a paycheck that you maybe have with the school. It's taxable. It's never been taxed before. So we do give you the option of withholding taxes before we pay you. That's something you can definitely do. But the partial lump sum is also taxable. So you have a couple options there. So you want to do some homework. If you're eligible for PLSO and you're considering taking it, do a little research, look into the options, consider taxes, reach out, ask us questions so we can help you navigate through all of that. So just to kind of review, so far we've understood how PSR's peers works, what it means to be in each of the systems and how they are different. And then we dived into vesting and what that means. 5 years is vesting. And then eligibility. So hopefully you have a little bit of a better idea of maybe when you're first eligible, maybe if you want partial lump sum, or if you need to look into a couple other options there. So up next, I want to switch gears and talk about purchasing service, because purchasing tends to be one of our most, if not the most, confusing topic ever. And I really think it's because every retirement is unique, every member is unique, and every purchase is unique. So there's no one that's like the other, right? It's all different, and it's all individual. So it's up to you and your circumstances. So today I'm going to give you a lowdown on purchasing, a high level, and then we're going to talk about a couple examples so you can maybe understand it better. And then I will get into the cost and maybe some things to consider. So a lot of times people will ask me, what is purchasing service? What does that mean? Buying back years, okay? And why would someone do it? Well, I'm going to refer back to that formula we talked about. So again, benefit factor, right? We know that's a percentage. Once you get to normal retirement, that's the highest number it can be. Final average salary, that's based on my salary. So again, I don't really have much control over that. Total years of service is what I have control over. I have control on how many years I work, and when I retire, how many years I have. And it's pretty simple math. The more years of service you have, the higher your monthly benefit's going to be. So for example, on the screen today, you see a typical formula here. If I were to retire with 25 years, in my example here, my monthly benefit is $2,600. But if I have one more year and I retire with 26, that's the only thing changing in that formula, is going from 25 to 26. Now my monthly benefit's $2,700. So you can see that adding one more year increased my future retirement benefit. Now to make that happen, I could work it, right? I have 25 years, I need one more, I work one more year. and then I have 26. That's pretty simple too. But a lot of people maybe don't want to do that. And so rather than work an additional year, you may potentially look into purchasing that additional year. So I could buy that year and then have 26 in my formula. That's why people do it. That's the first reason, right? Just to increase years of service. It's that simple. The second reason, though, is to get to retirement eligibility sooner. So remember back to the rule of 80. It's your age plus your service added together. So if I reach rule of 80, let's say in October of next year, I could work one more year and retire at the end of the year and things like that. Or I could potentially purchase a little bit of time to get me back to where I can retire July before that. And then I'm eligible for rule of 80 a little sooner than what I had first thought. So we have people who purchase for both of those reasons. Now, when it comes to purchasing, there's a lot of different options, okay? Most of the time people say, I have 25 years, I want to retire with 30, what can I do, right? I want to buy 5 years. Well, it's not that simple. You have to qualify to purchase service in our system. In a lot of situations, we look at where you previously worked to see if you qualify to buy those years. Not every situation, and I'll have a couple examples of when it's different. But if you've earned service every year for the last 25 years, okay, you've earned those years. So you can't buy those years. When you've been in our system, you can't buy those because you've already earned them. So you have to generally look at before. Where did you work before? So a lot of times when people ask me that, I'll refer them to that first. Where did you work before? And maybe you had time, military time before, or maybe you had time at a private school that you worked, or just public employment, whatever it may be. Any of those are going to fall under our basic cost purchasing. And our basic cost purchase uses this calculator that you see on your screen, which is your current contribution rate multiplied by your highest salary on record. So your highest salary ever, you plug into that second thing, the formula or the current contribution rate. All that information's on our website if you need it. It's different for PSRS and peers. And that gives you the cost. Now, a really easy way to figure what your cost is to log in to your web member services account, because we're automatically going to pull in your contribution rate. We're automatically going to pull in your highest salary. So you don't even have to know that. You just log in, run those numbers. It's going to give you that information. So that's a really easy way to do it. You can call us too, or reach out to us, and we're happy to help you through it. So a lot of our purchasing falls under this cost calculation here. Now, we do have some others that are calculated different, and I'll go through those individually here. I'm going to show you some examples, but this is by no means our only options, okay? You have a full list online that you could look into and see what you're eligible for. I'm just going to share with you a couple of our more popular options to give you some ideas. So Jeffrey is 55 years old, and he has 24 years of service, and he wants to retire in July of 2022, but he's short of the rule of 80, right? He can't quite retire yet if he wants to. He could under age reduced, but he wants to get to that rule of 80 mark. So he needs to buy an additional 0.43014 more service to get to exactly rule of 80 on the day that he wants to retire. He could work one more year to earn it, and then he'd be over rule of 80, but he doesn't want to do that. He wants to purchase it. Well, luckily for Jeffrey, we have something called supplemental. And the supplemental purchase provision allows all of our members the opportunity to buy up to a half a year. So a half a year, no questions asked, you can buy, assuming, or when you get closer to retirement, you're eligible to do that. So in this situation, Jeffrey says, yeah, I only need 0.43014. I'm going to do it under the supplemental purchase. So he files his application. He sends us the money. We credit his account with an additional 0.43014 more service, and he retires with 25.43014 years total, and that gets him exactly rule of 80 on that day. So next up is Carol. She's 49, so she's quite young for retirement, but she's been working a long time. So she's got 27 years total. And so again, you can see she's not quite eligible yet, right? She could retire under the 25 and out, modified, but she kind of wants to get to 30 years total so she can have the full benefit. For Carol, she had a previous job. Before she started in our system, she worked maybe at McDonald's or a grocery store or daycare or whatever else it may be, right? Private employment like that, she paid into Social Security during that employment. So she has 3 years total at the grocery store that she worked full time. She paid into Social Security during that time. And so we allow her to buy those 3 years in our system based on the Social Security purchase provision. So if she does that, she retires with a total of 30 years. Now, Social Security is a little unique, okay? We don't take anything from the Social Security system to do this purchase. We don't touch their system. We don't take money from their system. That's not how it works, okay? All we need you to do is prove it. We told Carol, prove that you worked at that grocery store. Well, maybe in her situation, well, that grocery store closed down. I don't have proof, okay? And there's a lot of times when that happens, right? That's why in order to prove it, we ask her to get a detailed statement from Social Security instead, because that statement's going to have all of her prior employment on it. It's going to show how much she paid into Social Security. It's going to prove it. And that's all we need, that detailed earning statement from Social Security. Now, it sounds simple, but it's not, okay? You have to request this from a local Social Security office. So it's not the statement you can print yourself. You have to actually request it for them to print it and give it to you. It currently costs around $90 for them to give you this statement, and their turnaround is different for every location. So some people wait months, 6 months, even a year before they get this statement from Social Security. So you want to plan ahead and try to get all this in place before so that you know this is how much I'm eligible for, this is when I'm going to do that purchase. So up next is Anna. Anna started her career with the school a little bit later in life. She's 59 years old, and she has 7 years of service total in the system. And so you can see that for her, she has to wait till she's age 60, right? She knows she has to wait till she's 60 years old to retire. But she has some time at a private school that she worked before. So just a little bit, less than a year, and she just kind of wants to combine the accounts, roll everything over from there to here. And so that's one of our purchase options is a private purchase. She can roll that time here, and we will go ahead and allow that to happen. If you have time at a private school, a different public school, maybe out of state, a state that we don't cover, something of that nature, you can purchase those years into our system, so that's a popular one to do. In Anna's situation, she still has to wait till she's age 60 to actually retire, but when she does, we're going to figure her benefit based on the 7.8 years instead of 7. So it's going to make her benefit go up just a little bit. All right. Okay, so then up next we have Maria. Maria is unique because she had a previous account with PSRS Peers. So that means she worked for PSRS or a school district for 4 years. And then in 1991, she quit that job and she took a refund of her account. She just took out those 4 years and took that money and ran. And then a couple of years later, she came back to work. And so now in her current membership, she has 23 years. So she decides, okay, well, I want to retire at 55, but I only have 23 years in my current membership. So could I get back 2 of those 4 years to where then I would be at the rule of 80? And that's what we call reinstatement. So she could buy back just 2 of the 4 years she has available. She could buy all 4 if she wanted to, but just for her 2 is all she needs to get to rule of 80. So she does that through the reinstatement. Reinstatement, again, is just for those who have those previous accounts. It is cheaper in most cases, so we will direct you to this if you have it available. And if you kind of wonder, well, what do I have? What are my options? Call us or reach out to us and we can send you information on your reinstatement. The cost for this does increase each month, so you want to be aware of that as well. Up next is Heather. Heather had some unpaid sick leave that she used in November of 20. So maybe she had a baby. Or maybe she had back surgery, in November of 2020, and she missed out on a portion of that school year. So rather than having 26 years of service, she has 25.7. So she's short by 0.3 of that year. Since this was leave that she took from the school within the last 2 school years, we give her the option of purchasing back that time under our unpaid sick leave provision. So if she buys it back, she's over the rule of 80 and eligible to retire. So you can purchase unpaid sick leave that you used with the school district, assuming they're okay with this. You contact the school, you work it all out through them, and you pay them for the time that you missed. But it has to have been leave that you had within the last 2 school years. So there is a little bit of a criteria there for that particular type of purchase. So then last we have Jacob. Jacob is also unique because he started out in the school system first as a peers member because he wasn't certified yet. He was working toward it. He was in school. So he got vested. He has 6 years in peers. And then he got certified. And so now he has 18 years in the PSRS system. Remember, they're completely different, right? So once he got certified, he moved over into PSRS. So now he has 2 accounts, peers and PSRS, one with 6 years, one with 18 years. He's not at rule of 80 in either one on its own, but what we allow him to do is recognize the 6 years he had in peers to get him to where he's over rule of 80 total and he can retire. Now he's still going to get 2 checks from us. When he retires, he's still going to get the PSRS check and the peers check. PSRS is based on 6 years, peers is based on 18, but it allowed him to retire early because recognizing them both got him to the rule of 80. So again, reach out to us if you have questions about that or any of these that we've just gone over. No matter which way you look at it, purchasing is a process, okay? First, you have to decide which one am I eligible for? How can I purchase it? Then you have to request and complete that application, and you have to have your time verified. So you have to send it to your previous school, maybe that private school, have them verify it. You have to prove that you had that unpaid sick leave. You have to prove your military time, or maybe get that detailed earnings statement from Social Security. Whatever it may be, you have to have that time verified. Send all of that to us, and then we will tell you how much you're eligible to buy. So we don't know until we have everything in front of us what you're truly going to be eligible to purchase. Once we tell you, then it's up to you. Okay, you go through all those hoops and you say, never mind, I really don't want to purchase after all. That's okay. It's not a contract. It's not an obligation. You're not required to do it. It's completely your decision. But if you get to the point where you say, yep, I'm eligible for 2 years, they told me I was, this is how much it cost, I'm going to do it. Then you pay for it, okay? You can do personal checks, so you can write us a check for the whole amount at once, or you can split it up and do monthly payments, however much you want to do there, or you can do rollover funds. Rollover funds mean you have an IRA or a 403B or another account sitting over here that you have money in. You can roll that fund to our system, tax-free, penalty-free, to pay for your purchase. So that's a really nice option as well. Your deadline to purchase is the day before you retire. So you have all the way up until you retire to get all of this purchasing complete. However, your cost to purchase is subject to go up every October. Every October 1, we do a recalculation, and your cost could potentially go up year after year after year in October. So you want to make sure if you are considering purchasing, it's typically cheaper to do it earlier on than to wait until right before retirement. So again, look at all those numbers and do that homework as well. So again, just to recap, we now know what the value of purchasing is, what some options might be, and we have a better understanding of if it's something I want to look into or maybe if purchasing is not really right for me. So again, it's a very unique situation. Reach out or do some homework online to get all of your questions answered. So let's move on to planning ahead, okay? We're kind of winding down on our time a little bit, so I want to talk about what are some things to think about in my next couple years or maybe if I'm getting really close to retirement. So the first thing I'll mention is our benefit estimates. They are your best tool for helping you decide when you're eligible and how much your future retirement is going to be. So on your screen today, you have kind of a snapshot of what our benefit estimates look like. We're happy to run these for you. Contact us. You can call, email, chat, whatever, and request us send these to you. Or it's super easy to run them online, okay? In fact, 50% of all of our estimates ran are members doing it themselves online. So it's a really good tool. Log into Web Member Services, that's your personal account, and it'll pull in all of your salary information. It'll pull in all your beneficiary stuff, so you really don't have to do much other than just kind of click through it, and then there it is. So you can run as many as you want, and then you can compare and look at different scenarios. But when it comes down to right before you retire, we're going to give you 3 different or I'm sorry, 6 different plan options to actually choose from whenever you retire. Now, you're not going to make that decision until right before, right? When you're filling out your forms, this is my year, I'm doing all this, that's when you'll choose this. But we want you to know ahead of time, you have some options whenever you officially retire. It's not just you and only you. We do have a single life option that you can choose so that when you retire, you get the highest monthly amount. And then upon your death, the plan just ends. And that's kind of how it's designed to work. But we also have some survivor options, which we call joint and survivor, which says, you know, maybe I want to leave something to my spouse after I'm gone. So when I pass away, he continues my benefit. Or maybe I have a child I'm taking care of and I want to make sure they can continue my benefit. So that would be the joint and survivor options. And there's 3 options there. There's limits on how many you can or who you can list, and there's criteria for it. So you want to do a little bit of research about that too. Just know that you're choosing a reduced benefit if you take joint and survivor, but it's still a really nice option for people. And then we have our term plans, which basically says, I want to promise my beneficiary that if something happens to me pretty early in retirement, that they will still get a couple payments. So it's just a short amount of time that I'm going to take care of them and make sure they're good to go beyond that. So we have a term plan, which again reduces my benefit a little bit, but protects the beneficiary for a certain amount of time. So all of these are what you'll make the decision of whenever you file for retirement. But we just want you to know, start doing a little bit of research, maybe 3 to 5 years away from retirement. That's a good time to start running these estimates, look at your plan options, maybe have an idea which one you think is going to be best for you. So a couple other things I want to mention. Beneficiaries right now. So in our system, you already have beneficiaries on file, or I hope you do, because you should. And that's the reason for that is because if something happens to you now as an active employee, your loved ones have options. They have access to your retirement. So we want to make sure that we pay who you want us to pay if you passed away while you're still actively working. So contact us to update your beneficiaries. So it's really easy to do. You just fill out a new form. If you've never done it before, you can fill out a new form from the very beginning. But starting tomorrow, because this is an enhancement that we're making to our website, you'll be able to update and change your beneficiaries online through your web member services account. So that's going to be in effect tomorrow, September 1st. So easy. You log into your online account, update your beneficiaries, hit save, submit, and then it's good to go. Contact us if you have questions about who your beneficiary is, or you can log in to see all of that listed as well. It's very easy to do. Just make sure you always keep them up to date throughout your career. Ending covered employment. I talked about this a little bit before, but just in the back of your mind, always remember it's your money, right? Your money at PSRS Peers. So if you end employment and you go somewhere else and you don't want to retire with us in the future, you have access to your account. So just call us and we'll send you the refund paperwork. We'll give you all of the options that you have. And if you're vested, you can just leave it here and we'll pay you a retirement benefit later on. So we'll reach out to you later if that situation occurs. Your member statements come out every fall. So we're getting ready in a couple months to send those out to you. And really a member statement is your snapshot of your entire account. It shows you your balance, shows you your beneficiaries. It shows you what your spouse or your loved ones would get if you passed away before retirement, shows what your future benefits look like at retirement. It lists every year you've worked and every employer and every salary, all on there. And it comes out in the fall. So just look it over once you get it. But if you want to kind of look in the back, maybe what last year looked like or the year before, we always keep up to 5 years of your member statements in your online account. So it's the best file cabinet you could ever have, right? You don't have to keep a paper copy. We have them all out there for you. Social Security, we get a lot of questions about it. And unfortunately, I can't see their system, so I can't really answer a lot. What I can tell you, again, PSRS members typically don't pay into Social Security, but peers members do. However, we have a lot of members across both sides who have 40 or more quarters in Social Security, either from other employment or whatever that may be. So what I'll tell you is whatever you get from Social Security, your future benefit with Social Security, it's never going to affect your PSRS or your peers retirement. So you don't have to worry, well, if I collect Social Security, my PSRS is going to be reduced. That's not the case, okay? We are going to pay you based on your information in our system. So that's going to be in addition to whatever Social Security pays for you. But if you are a PSRS member and you haven't paid into Social Security during this employment, then you might see a reduction in their benefit based on a couple of the provisions that they have in their system. So all I encourage you to do is to either go on their website and just do a little bit of research or homework, or sit down with a local representative and try to get all your questions answered about them. But just know you'll always have us. We're not going to change or alter your benefit at all based on what you get from Social Security. And after you retire, as far as health insurance goes, one thing I'll mention is whenever you officially retire, you can continue your school district's health insurance if you want to, but obviously you have to pay for it. So that's something you'd set up with the school before you retire. And then at age 65, you'll get Medicare, which is the government health insurance that everybody qualifies for at age 65. And then finally, I've said it enough, I'll say it one more time. Web member services, okay? It's your online account. It has everything out there for you. You can do so much stuff. We're still here to help if you need us, but go around, play online, create a membership if you haven't already done it. So lots of ways to stay connected, stay educated with us. We have so many options for you. We're virtual today, and that's an amazing way to communicate from the comfort of your home. And so we've tried to adopt that in some of our education options. So we have webinars that we offer monthly, and we call them featured topic webinars, but they're really over just a specific topic. So let's say you have more questions about purchasing. We have an entire webinar over just purchasing. Or maybe you're getting close to retirement and you want to know what to expect after retirement. We have a whole webinar on just that as well. So go on our website, our external website, and it'll list all of the dates and times that we have our live webinars. And it's just like you and me today, right? It's me talking, and then in the end, I give you the option of asking me a question as well. Real Talk is very similar, but they're short. They're only like 15 minutes, and it's only over a hot topic or a frequently asked question or something like that. Those are also on our website. We also offer individual counseling. So you can come visit us in Jefferson City. That's where our office is. We'll sit down across the table from you and have a one-on-one individual session with the counselor, or you can do that same thing through the computer. We call it web counseling. Counselor talks to you individually about your account. The other one is a phone, and that's just where the counselor calls you at a day and time of your choice and talks to you about your account. So lots of ways to connect with us, and it's really up to your preference. We are here if you just have general questions. You can call our information center. We're happy to help and answer those. You can email us questions you might have. And if you log into your online account, you can chat with us as well. So that's a really great way. And then our website is listed there for any questions you might have after today. So I think that's the end of my presentation. And I do see a couple chats and Q&A, so I might bring that up real quick. So one of the chats was just, I have some Social Security time before I started. Who can I talk to about my purchase? Or is that formula under your website? It's probably best to call us. Call our information center. That number's on the screen that you see here, and we can kind of look at your account, pull it up, and say, I think this might be the best option. Let me send you some information. So just give our office a call. We're happy to help with that as well.
Awesome.
And then
looks like we have a couple questions in the Q&A as well.
Yep.
You're able to
see that as well. Yeah. So the first one is, I'm in PSRS, but do not have a DESE certificate. Is this wrong? Because it's a community college situation, that's not the case. So our community colleges actually are able to certify positions. And so there might be some of you listening today who are in that same situation where you don't have that certificate, but you're in PSRS. So feel confident in the fact that your school district has reported you correctly, so you don't have to worry about that. But it's one of those reasons why you might go online in your own account because it'll tell you if you're in PSRS or peers, and that way you can see and definitively know, oh, I'm in a PSRS category or I'm in a peers category. Obviously, you can reach back and ask your school district as well, but they are a little bit different in that aspect. So hopefully that answers that question. The other question is, if I worked at one university and then went to work at another, do they all total together? And the answer is, assuming they're one of ours. So, and PSRS Peers covers all the public schools in the state of Missouri and 2-year community colleges. So we have a lot of those in and across the state. If you go from one to the next, let's say you go from, Pattonville School District to St. Louis Community College or whatever that may be, then yes, it's fluid, right? It goes straight from, we just basically change your school district in our system, and that's all we do, but you're still earning, contributing, everything. But if you go to a different school district, maybe in Illinois, or a four-year university here, maybe the University of Missouri or something in Columbia, we don't cover them. So then you're not paying into our system when you work for that employer. There is a full list of our employers on our website. So you can look and see there, or you can ask the school district before you accept the job, who's your retirement? The other thing is we don't cover St. Louis City Schools or Kansas City Inner City Schools. So those, they also have their own retirement. So again, you just kind of want to check into that before maybe you make a change in your location. Hopefully that answered that. So any other questions real quick, you feel free to chat them or put them in the Q&A, and I'm happy to answer. Otherwise, I think that's all I had today. So
Awesome. Well, if there aren't any other questions, we'll go ahead and wrap things up for today. Oh, looks like there was another one that just popped up in the chat there.
In the chat. Okay. So the question was, can you roll over 4 years to the 2-year? Is that in reference to?
I think maybe a 4-year, yeah, 4-year university to a 2-year.
Oh, okay, I understand. So yes, if let's say I worked for the University of Missouri for 2 years in their system, I paid into their system, quit that job, and then now I came to work for one of the community colleges here in Missouri, so I'm in PSRS peers. That is an eligible purchase type. So I can qualify to purchase those 2 years from MU into the community college. But if I have an account there, that's great. But in most cases, it's really just where I'm qualifying to purchase those years, but I'm still having to pay for it, right? I have to pay either out of my personal funds, or if I have funds in a rollover, I can roll them over. The university isn't sending us money to pay for it, and they're not transferring your years from them to us. It's where you're purchasing those years that you worked in that school district. So hopefully that helps. But that is one of our types of purchasing options available. Yeah. Okay.
Great. Well, thank you so much for joining us, Amanda. Very valuable information for us. I will make sure to get a copy of the slides out to all of our members with the recording. So thank you again, and we appreciate you being here today.
Yes, absolutely. I'll send them over to you so you have them, and thanks so much for having me.
Awesome. Thank you.
Thanks.
Just a couple of last few things before we wrap up for today. We do have a couple webinars coming up in October. So our Allied Health Conference, that is usually an in-person event, we've decided to make that virtual this year. So that will actually be a 2-part webinar series. And then we also have a webinar with Arkansas State University on increasing writing proficiency. So stay tuned for more information on those. And then, of course, our annual convention is coming up in November. So we hope to see you there. So thank you all again for joining us. If you have any questions relating to today's webinar, please don't hesitate to reach out to us. I hope everyone has a great day and great upcoming Labor Day weekend. Thanks. Bye.